Samir, great to have you on the show. Let's first talk about what's happening with JP Morgan. I mean, certainly we're very happy about this over here in Nigeria. We've seen evidence by what's happening in our bond market. We're seeing yields down. Certainly offshore investors seem to be flowing in. But where does Nigeria rank in the index compared to other countries? Looking across the 10-year maturities, we seem to be on the high side when it comes to yields.
Hi, Uche. Yes, definitively. In terms of yields, I think Nigeria will definitively be at the upper end of the range. Although rates have declined, they're still in double digits, while the median yield on the 10-year bond among the countries in the index is about 5.7%. And the top country right now is Brazil with 9.5%. And then you have, I think, Russia at 7.7%. South Africa, for example, is at 6.9, and you have countries like China where it's 3.4%. But that can be explained, I think, in a sense, because Nigeria has a higher rate of inflation. The monetary policy stance in Nigeria was somewhat at odds with the global rate cycle because there was a tightening, while in most emerging markets, actually, central banks cut rates. And perhaps, actually, an interesting point on liquidity, the liquidity in the Nigerian bond market has improved recently, in recent years. It's probably now 20% of that of South Africa, and it's definitively more liquid than other markets in Africa, such as Egypt or Morocco, and maybe even more liquid than other minor countries in the index. So that in itself should not be an issue, actually.
Well, Samir, very quickly, I mean, consensus is that our bonds will have a weight of around 0.59% on this index. Now, this doesn't seem like much. What is your take on this weight? And, of course, how much flows do you expect to see coming in, being generated with this weight?
Well, in proportional terms, obviously, it's a very small weight. But we have to take into account that the size of the Nigerian market is not that huge, and that the inclusion actually focuses on three maturities. So one of the 2014 bonds, one of the 2019 bonds, and the 2022 bond. And if you take the 2020 bond, the 2022 bond, the size is about $1.5 billion US right now. Now the 0.59% will represent about 1 billion of inflows. So actually, it's a sizable amount if you compare it to the free float of the three bonds that will be included in the index. And that's probably why actually we've seen this sharp rally in expectation for a squeeze in supply in coming months.
Samir, any impact on the shorter end of the markets? Are we going to see it impacting, especially we have a T-bill auction coming up tomorrow of about 152 million naira. Do you see this news impacting our T-bill market at all?
Well, it seems that the short end and the longer end of the curve are somewhat disconnected at present. I mean, the long end is obviously riding because of the inclusion of selected bonds in the index, as well as the improving inflation outlook. At the short end, we don't think that the central bank will allow a collapse in yields. And I think, the issue here is that if rates go down, let's say to 10%, then that's going to jeopardize exchange rate stability. And the nominal policy, the nominal monetary policy anchor for the central bank is dollar naira. So they want to keep liquidity in check. We've seen that in recent days because they've resumed open market operations. And actually, some of the OMO printed at 14 to 14.5% discount, which is quite high. And the expectation is actually that at the auction, we could see an increase in yields from current secondary market levels. So that's above at least the 15% where the 1-year T-bill is trading now. We could easily be somewhere between 15 and 15.5% tomorrow, and maybe even higher.
Well, Samir, I mean, give me your take overall then on our fixed income market. I mean, certainly the market fundamentals seem to be ideal for fixed income investors. With this JP Morgan news coming out, we're seeing liquidity remaining tight over in our markets. Inflation definitely is coming down. And generally, there seems nothing to worry about just yet on the macroeconomic front. What is your take?
Well, I mean, obviously there are risk factors that cannot be ignored, and I agree with you that the situation right now looks okay, but onshore, the big problem is the magnitude of fiscal expansion, and I'm talking here about the overall fiscal expansion at the three-tier level. As you know, the increase in fiscal savings in the excess crude account has been very muted. That could be a problem if this is combined with an external shock. So if the oil price were to fall at some point in the future, it remains to be seen how Nigeria would withstand the shock. But for now, yes, the oil price is high. It seems that you know, the issues in the Eurozone, the weak economic growth in the US, do not really have any negative impact on global market perception. And you know, if you look at the oil price, at global assets, they've all rallied recently. So as long as this trend can hold, then Nigeria and its market should be fine. But there are some long-term risks that should not be discounted.
Well, thank you so much, Samir, for giving us your take on Nigeria's markets there. Of course, you do know we're expecting some auctions coming up both in Ghana. Their finance ministry announced today they may issue a new Eurobond in 2013. And over in Cote d'Ivoire, the government is also in the process of issuing a 5-year, $120 million bond at 6.5%. Thank you so much, Samir. We'll continue to watch these markets. That was Samir Gadio. He's an emerging market strategist with Standard Bank.